Welcome to the deep dive. Today we are plunging into, well, one of the most fundamental barriers facing newcomers and immigrants everywhere, really, but specifically here in the U.S. and Canada, just finding a stable place to live.
It's a challenge that honestly shouldn't exist for so many people, especially high-income professionals or, financially disciplined families. But it does.
And our mission today is pretty clear. We're taking the stack of sources you provided us, and we're going to unpack these alternative pathways to housing.
Things like rent-to-own.
Exactly. Rent-to-own, specialized mortgages. But, and this is critical, we really need to spend time on the serious pitfalls.
Oh, absolutely. And the profound systemic barriers that are baked into these markets.
Right.
And if you look at the big picture, the core problem often isn't about money. It's not financial capability.
Yeah.
We're talking about people with significant savings, stable, high-paying jobs, but they hit this immediate and often just insurmountable roadblock.
The lack of a domestic credit history.
That's it. That one single thing creates this devastating sort of chicken or egg conundrum that stalls everything.
From opening a bank account to
securing a lease or a mortgage, it's foundational.
That is the perfect place to start. So let's unpack this. In the U.S., the FICO score is, it's essentially your passport to financial society.
It tells everyone if you can be trusted.
And our sources point out that for new immigrants, even if you have decades of perfect credit history from, say, Malaysia or Germany,
Or India, yeah.
it all amounts to, and I'm quoting here, a big fat zero. Why is that?
Well, it's really a failure of standardization, and it's also tied up with privacy laws.
So the systems just don't talk to each other?
They don't. Foreign credit bureaus don't communicate directly with U.S. or Canadian ones. There's just no automated system to translate a perfect payment history from a European bank into that 3-digit FICO score.
So the American system treats a newly arrived doctor the same as someone who's defaulted on every loan they've ever had.
Legally, ethically, and technically, yes. They both start at zero.
And the result of that is just staggering. I was looking at one source, the FDIC National Survey. It says nearly 36% of foreign-born non-citizens don't use mainstream credit. And about 51% are either unbanked or underbanked.
That's half. Half of a massive financially active population that is being forced outside the traditional economy.
Simply because the system refuses to see them.
Exactly. And that just raises the huge question. How do you even put a roof over your head at first?
If your credit invisible.
Right. You have to rely on these immediate high-cost workarounds. Landlords, especially the big corporate complexes, they'll demand massive upfront payments.
We're talking, what, 2 or 3 months rent?
Or more. We've seen requirements for 2, 3, sometimes up to 6 months rent paid in advance, plus the security deposit.
That is a huge amount of cash to have on hand. It's a massive liquidity drain just to sign a simple lease.
And an emotional toll, too.
Yeah, I was really struck by that story in the sources. The newcomer in New York City earning $165,000 a year.
And still couldn't get a lease easily.
Right. Still had to prove their stability with bank statements because that 0 U.S. credit score was a bigger red flag than their 6-figure salary.
And that is just a profound failure of integration. It really is.
So what are the other options?
Well, if they're lucky, they can bypass the credit check by providing that alternative proof, employment contracts, those bank statements.
Letters from their fancy new employer.
Exactly. But if they can't do that, they get pushed toward much less desirable options.
Which means relying on friends or family to co-sign.
Or turning to professional guarantor services.
Where you pay a company a non-refundable fee.
A hefty fee, usually.
Yeah.
And they basically act as a paid voucher for you, taking on the liability.
And I imagine for many, the only real option is finding a smaller, private landlord.
It often is. Those individuals are just more flexible. They might rent unofficially or accept cash because they don't have these rigid institutional vetting processes.
We have to talk about the personal cost here. It's more than just an inconvenience.
Oh, it's about dignity and risk.
For sure. That same source detailed a professional engineer, totally financially solvent, but just repeatedly rejected.
By banks, by landlords, yeah.
It forced them to rely on their immigrant network for basic things, like a car loan. And that loan came with a 20% interest rate.
When the market average was, much, much lower.
Exactly. That's predatory.
That example just perfectly illustrates the opportunity cost of being credit invisible. When the mainstream doors are locked, you're forced into high-risk, high-cost debt just to function.
Which is the connective tissue that leads us right into alternative ownership.
It is. If you can't get traditional credit and renting is this huge cash burden,
Yeah.
where do you turn for stability, for equity?
That's the perfect pivot. Let's look at that path. Rent to own. You also hear it called lease to own or a lease purchase contract.
Right.
Can you just walk us through the core mechanics? How does it actually work?
Absolutely. The RTO model, at its best, is designed for people who need time. Time to save a full down payment, and crucially, time to build that domestic credit history.
Okay, so what are the components?
It has three core elements. First, the buyer pays an upfront, non-refundable option fee.
A deposit.
A deposit, yeah, usually between 2 to 10% of the home's purchase price, and that fee is immediately credited toward their future down payment.
Okay, so it's not lost money.
Not at all. Second, there's the monthly payment. The rent is usually a bit higher than the market rate, and that extra amount, the rent premium, is also credited toward the purchase price.
And the third element, this seems like the most valuable one, especially in a hot housing market.
Oh, it is. The purchase price is locked in upfront.
When you sign the contract.
Right, for a term of, say, 2 to 5 years. And that price certainty is a massive protection.
Because if you're trying to save a 20% down payment, but the house price keeps going up.
You're always chasing a moving target. RTO protects you from that.
And specifically in the Canadian context, our sources highlight some really key advantages for newcomers.
Yes, for new Canadians, RTO is huge for two main reasons. One, it gives them time to save that down payment, which can be anywhere from 5 to 20% without a strong credit history.
And the second reason.
Two, many of the reputable programs will actively build their Canadian credit history. They report those on-time rent payments to the credit bureaus.
That step alone must be gold.
It's everything. Because when they finally go to apply for a standard mortgage in 5 years, they have a positive track record to show for it.
The sources mentioned providers like Requity Homes in places like Alberta, Ontario.
Manitoba, Saskatchewan, yeah. They offer guidance. They have real estate partners.
But that kind of built-in support network must be so reassuring for someone totally new to the North American system.
It provides a level of institutional trust that's often missing.
Now, you mentioned contracts. We have to clarify the types because the difference sounds like it has massive real-world consequences.
It really does. So you have a lease option that gives the tenant the right to buy, but no obligation.
So you can walk away.
You can. If you decide not to buy, you lose that option fee you paid, but that's it. You're clean.
But then there's the lease purchase. What happens there if, say, the market crashes and you're obligated to buy a house that's now underwater?
That's the danger. In a lease purchase, you are obligated to close the deal. If you fail, you're in breach of contract.
So you can be sued.
You can be sued, and you will almost certainly lose your option fee and all the rent credits you've built up. The fine print is absolutely essential.
And here's where it gets really interesting. And, frankly, dangerous. The sources flag these arrangements as being ripe for scammers. Given that they target people locked out of traditional credit who might be desperate, what are the biggest risks?
The primary danger, especially with the U.S. schemes they call contract for deed, is the total loss of your investment with zero protection.
What do you mean, zero protection?
Unlike a mortgage, where if you miss a payment, it triggers a whole foreclosure process that protects some of your equity.
Right.
In many of these predatory agreements, if you miss a single payment, you are treated just like a renter.
So they can just evict you.
Immediately. And you lose everything you've paid in, the option fee, years of rent credits, any money you spend on repairs, it's all gone.
That is just shocking.
Yeah.
And the contracts themselves can have hidden liabilities. The sources brought up that awful case of the Torres family.
Yes, that was just egregious. Their contract illegally shifted all the landlord's duties onto them.
So they were paying the property taxes.
Paying taxes, making all the repairs. They ended up spending $12,000 on repairs and inherited a mess.
112 housing code violations.
112. And unpaid back taxes that were the seller's problem. I mean, that's not a purchase agreement. That's a financial trap.
Absolutely. And it's not just hidden repairs. The sources talk about outright fraud.
Oh, yeah. Sellers offering a home that's already in foreclosure.
Or one they don't even own.
Or not disclosing serious hazards like lead paint or mold. It's predatory because it specifically targets low-income communities and people of color who've already been locked out by things like redlining.
So the essential takeaway is that these deals exist in a kind of legal and regulatory gray area.
A protection gap. And while some states have regulations, they're often ineffective, leaving the market wide open for this stuff. Consumer education is really the first line of defense.
Let's pivot now to the U.S. and another huge systemic barrier, the ITN, the Individual Tax Identification Number.
Right.
For those who don't know, these are for individuals who are required by law to pay federal taxes. And they do, but they aren't eligible for a Social Security number.
Often due to their undocumented status or certain visa types.
What's so fascinating here is the sheer size of the housing market just sitting there, untapped.
It's massive, primarily serving Latino households. Right now, the estimates show only about 5,000 to 6,000 ITN mortgages are made each year.
And the potential.
If the barriers were removed, that could skyrocket to maybe 73,000, even 88,000 mortgages annually.
That's a massive economic driver just being suppressed.
And here's the paradox. The data, the lender interviews, they all overwhelmingly show that ITN loans perform just as well, if not better, than loans to people with Social Security numbers.
Really? Why is that?
There's a documented strong financial discipline and a real debt aversion in these communities. Delinquency rates are often lower.
So if they're great borrowers and the loans perform well, why do they face much stricter, more expensive terms?
It's that systemic barrier again. ITN borrowers face way higher interest rates, generally 50 to 200 basis points higher.
So that's 0.5% to 2% higher.
Exactly. And much bigger down payments. 10 to 20% is typical compared to 3.5% to 5% for a standard FHA loan.
That higher cost just prices so many people out. So what is the single biggest barrier preventing those 88,000 potential loans from being made?
It's the lack of a secondary market.
Okay, break that down for us.
Those lenders don't want to just hold on to thousands of mortgages. They want to sell them off to free up capital to make new loans.
And they usually sell them to government-sponsored enterprises, the GSEs, like Fannie Mae and Freddie Mac.
Precisely. And the GSEs won't buy ITN loans.
Generally,
no. Fannie Mae, Freddie Mac, and the FHA, they all require borrowers to prove legal presence in the United States.
And that one rule is the bottleneck.
It eliminates the largest source of liquidity for lenders. Think of it like a car dealer who can't sell their inventory to a wholesaler.
They have to hold all the risk themselves.
Right, which means they have to charge a higher price and demand a bigger down payment just to protect their own balance sheet.
That makes it perfectly clear. The policy barrier is directly responsible for the higher costs for borrowers.
And it's an administrative policy, not necessarily a legal mandate. It could be changed by simply removing the legal presence requirement for certain programs or by standardizing the loan specs to attract more private investment.
And there was another key point about this population.
The fear factor.
Yes.
Many undocumented workers are reluctant to even get an ITN because they're afraid of information sharing between the IRS and the Department of Homeland Security.
Immigration enforcement.
Right. Publicly clarifying that relationship would reduce fear and encourage more people to become tax compliant, which helps everyone.
It's vital that newcomers fighting these barriers know their baseline rights. Let's just remind everyone listening what their rights are under fair housing laws in the U.S.
Absolutely. Federal, state, and local laws prohibit discrimination based on national origin or religion, and these protections apply regardless of immigration status.
So what are some clear examples of illegal practices?
It is illegal for a landlord to refuse to rent to you because you don't speak English or are from a certain country.
Oh.
They can't charge you a higher rent or security deposit because of your national origin or religion. And critically, they cannot threaten you with deportation or tell you to go back to your own country.
Or have special rules that only apply to immigrants.
Exactly. If you see that happening, there is legal recourse.
Beyond legal protections, we're also seeing community organizations stepping up to bridge these gaps.
We are. Credit unions are vital here. Because they're community-focused, they can use alternative ways to underwrite loans.
They look at things other than a FICO score.
Things like a consistent record of paying rent, utility bills, even international credit reports. They serve the community in a way the big banks just don't.
And then there are nonprofit welcome centers, like the ones in Illinois.
They provide what they call a warm handoff. They connect immigrants with critical resources, everything from eviction prevention to help with ITIN applications.
They're essentially building the support system that the financial infrastructure has failed to provide.
Exactly right.
So if we connect all these dots, what do we see?
I think you see a really striking dichotomy. On one hand, you have alternative paths like RTO, which can be a structured, necessary way for newcomers to save and build credit.
And on the other hand,
On the other, the U.S. ITN market reveals this massive, financially disciplined, credit-worthy population that is being severely underserved because of, frankly, unnecessary lending requirements tied to legal status.
absolutely, the housing market, by relying so heavily on these arbitrary metrics of domestic credit and legal presence, it just forces newcomers into high-risk or much higher-cost options just to get basic stability.
Yeah.
The knowledge we shared today, hopefully it helps eliminate both the viable paths forward and the predatory risks you have to avoid. So a final thought for you to chew on as you go about your day. Considering the high performance and financial discipline that ITN borrowers consistently demonstrate,
Yeah.
and the estimate that maybe 88,000 mortgages are going unmade every single year because of an administrative policy, what is the true comprehensive cost to the economy, to local tax bases, and to society of enforcing these legal presence requirements for mortgage access?